what is the first question that goes through your mind when you're thinking about mortgages? Isn't it the mortgage rate? In this video, I'm going to show you how to focus on one number that's more important than the mortgage rate, which is the cost of borrowing. We have a problem where, as consumers, we're losing hundreds of thousands of interest just because most of us are just focused on the interest rate. And the only lever that we have is going to rate sites, talk to different lenders, talk to a broker, and try to negotiate a lower rate at renewal or when you are getting a mortgage. And I think it's wrong that most people are paying a lot of money to the banks in interest expenses because they have mortgages. Now, I want you to understand the definition of the cost of credit, which is the total dollar amount you pay to borrow money, expressed in dollars over the total length of your mortgage. The best way possibly to show this is via an example. We have a property worth $950,000. We have a mortgage of $455,480. We negotiated the best rate at this time for this loan, which is 4.29, and that yields a payment of $2,469. Now, this graph here on the left-hand side, you have the amortization schedule when you focus on the rate, 4.29, which is the lowest rate. And then if we take this table, this is over the 25 years of the loan, and we add all this interest, it yields or it gives us $293,581. Now, when we try to optimize for the lowest cost of credit, so how do we do in order to pay less money to the bank? We secure a cost of credit of $196,243 and an interest rate of 4.49. Big difference between the two options. Now, when you optimize for the mortgage rate, you do save money. In this case, the 0.2% difference give us on a 5-year term savings of $4,554. When you optimize for the cost of borrowing, we were able to pay it off sooner in 9 years less of payments, which were savings of $266,551. The question is, how do we do this? Let me show you in the next video.